All right, so thanks for joining me in today's video. And what we're going to do in today's episodes, we're going to take a look at Nvidia. So Nvidia's been pretty big in the news lately, and there's been a lot of publications around Nvidia stock. So boom, 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 40% this year. Could have hit $1 trillion market cap, best AI. A lot of stuff going on with Nvidia. So what we're going to do is we're going to take a look at 3 different ways to play this stock with options. So I'll give you a couple of ideas. Obviously, this isn't like the full scope of managing a position, spreading risks, that kind of thing. But I will give you some insights to maybe opening your mind a little bit further. This is kind of what I do with the coaching and mentoring things. So definitely check out the website if you're more interested in that. All right, so let's go ahead and take a look at Nvidia here. And I'm going to go ahead and just pull this up in the account. Now, I do have some shares already in this. This is a paper account, so just to go ahead and give you the scope of things. So you will see some of those positions. But look, the stock's already quite high when we look at just the technical patterns behind it. So how do I play something like this that's already very, very high? How do I go ahead and get something already that's at the upper level? So one of the ways to do that is to go ahead and sell a naked put. So by selling a naked put, what you're doing is you're looking to buy that stock at a cheaper or lower price. That means you do have to take the shares and buy that stock when it comes down to your price level. However, for waiting, you go ahead and get to collect a premium and some money and income. So let's go ahead and check out how we might do something like this. The stock is currently at 391. So let's say, hey, I'm okay to take that stock at 350, even at 300. Shoot, that'd be great. So what we can do is go to the trade tab and say, hey, you know what? I want to be super conservative, or I want to be a little bit more careful with Nvidia here, and say, you know what? If this thing pulls back, I'll pick it up, but otherwise I'm not going to go ahead and chase it. So what I'm going to do is go and look for, this is around 30 days out, go something around the $300 price range, but you can see I'm only going to get 48 cents. So what I could do, 48 cents, 48 bucks, what I could do is go further out in time, like 67 days out, and now I can go to the 300 level over here and see, is that going to be worth it? 200 bucks for 2 months? To wait. You know, that's how you have to do the calculation. Well, $300 dollars on that stock, divide that, and you're going to get about 223 bucks. Is it worth it for you? So obviously, I don't know your risk tolerance, your risk levels, but it might be worth it for you. So you could go ahead and sell one of those options. Now, I already have a ton of options already on Nvidia, so I'm going to go ahead and hide all those positions. So let's just go ahead and do this one. So what that's going to do is go ahead and give me a little bit of collection over here on that stock. So basically you make 200 bucks as long as it stays above that level. You're good. You don't need the stock assignment, but if it pulls back, you do get another 100 shares. So that's okay. So that's what you could do, is you could go ahead and do something like that. So that's one way of doing it. The downside is you got to have the capital to take that stock if it comes down into those levels. Okay. Let's look at idea number 2. Idea number 2 in our case is going to be buy an out of the money a vertical spread. So when we look at buying an out of the money vertical spread, okay, this strategy is a little bit different in that now you have a predefined risk. You don't always have to take the shares. But again, you might say, hey, you know what? Let's give it 67 days. I could go ahead and get one about a 35 delta or so, maybe 40. You don't want to go too far at the money, because if you go at the money, it's going to be a little more expensive. Out of the money, it'd be a little less expensive, but you do have the time decay problem. And because I have the time decay problem, that's where I'm going to go about 67 days out, a little further out, give myself a little room for the stock to actually maybe go sideways and then move a little higher. So we'll go around here, $5 wide, that's $500 worth of risk. Okay. And let's analyze this trade, go to this risk profile right there, but the one I'm selling versus the one I'm buying, I'm really only paying about $180 for that to maybe make 320. Again, you'd probably take it off early. You wouldn't hold it till expiration, but this is kind of another way to play it. You don't have as big of a theta decay because you're still close to at the money. And you've got a little bit of possible movement, and you're risking a little bit less capital. So again, this is another way to play it. You could go ahead, send it in. Nice advantage to this is you don't have to risk a lot of cash or capital. So if you don't have a lot of capital, this is a nice way to approach it. So that gets me to kind of idea and concept number 3. And that would be to look at buying an out of the money butterfly bomb. So what you're doing with an out of the money butterfly bomb is you're actually looking for, again, stock movement and a price movement But this one, the risk is even more defined, and you can spend even less capital and less money on it. So the way you might do it is you might say, look, what's the expected move? The expected move is around 60 bucks. So current price is 390. I might add 60 bucks. So that'll put me at around 450 on the price. So I'll take the 450, put my butterfly somewhere around here. Okay, and let's say, hey, maybe I expect that stock to really shoot higher. I'll go ahead, buy, and then we'll go to butterfly. And now I've got a $5 wide all over the place. And then the next 60 days. Now, the one thing with this one is you can see it's a very small amount of risk, $5 here, not really a lot. What we're going to do is we're going to actually widen that width to about $10 wide, just a little bit more. I'm not going to go too wide, but now what I'm risking is even less capital than the vertical spread. I'm risking 30 bucks, but if it continues to kind of move, you could make about 20, 30 bucks. Also, you have a nice theta decay that'll come in very strong and powerful as it comes into your value or short strikes. So let's go ahead and widen this a little bit more. Let me bring it back here for you. So with time, what's going to happen is there's a big bleed with butterflies. So that means they go outside the range. Don't look at the expiration picture as much. Just look at the white line. And you can see that as it pops higher, you do have a nice potential there. If you wanted to maybe have a higher possible probability, you could bring it in a little bit closer. The problem with that is you're going to pay a little bit more for that butterfly. But at least now you're, some points a bit higher. And as it passes through that range, you can take the butterfly off. So you're really just putting on a $40 trade here because that's the most at risk here is about 35 to 40 bucks. So that's another way of doing it. And then you can go ahead and send that in. So those are kind of the few ways to go ahead and set up a few different trades here when it comes to trading Nvidia stock. After all, the stock is quite high, and there's a lot of issues there that, with getting a stock that's so high that, has some problems. What you could do is taking a look at what we're doing today with Nvidia. I mean, stock's already up $4. You got a Microsoft also up $4. AMD's up $4. They're all like up $4. Intel's up $1.58. Apple $2.33. So they're all kind of pushing to that upside a bit, and it's tough to kind of chase those things when they're already up so high. You might be pulling your hair or grinding your teeth trying to get in them. So this is one way of doing it, is through options in a few of those ways. Obviously, there's many more ways of doing it, but this is just kind of 3 ideas for you to check out and see if it makes sense for you. Anyways, thanks for joining me. Enjoy the week ahead, and I will see you next time.